Good afternoon. My name is Marc Jones. I'm the Associate Editor of Reactions magazine in London, and I have on the line Stefan Holzberger, the Chief Rating Officer of AM Best. Stefan, thank you for being here.
Thank you. My pleasure, Mark.
Stefan, what kind of impact does AM Best think that the coronavirus will have on the insurance market?
Well, I think it's hard to say definitively at this time, really what are the overall implications of COVID-19 to the insurance sector. We do know that certain classes of business are going to be hard hit, whether it's D&O from the market volatility, E&O from the agent and broker side around potential coverage disputes, and then you have the certain specialty classes of business like trade credit, surety, mortgage insurance, certainly, that are more broadly tied to macroeconomic conditions. So in those lines of business, we certainly expect to see some increased loss experience, and just companies that are writing those lines of business will be challenged to meet their targets in this environment. For the workers' compensation line, there where a lot of the revenue or the premium is based on payroll, it's going to see a reduction in top-line revenues. In the U.S., for example, workers' compensation has been a very well-performing line of business over many years. Rates have been softening in that line, but we've seen a good amount of pricing and underwriting discipline. We think that innovation has a lot to do with that. Predictive analytics and modeling around risk segmentation and pricing has helped that line. It will be challenged with a reduced top line, but we do feel that that profitability should hold overall in the U.S. For workers' comp. And then kind of more globally, motor, as has been written about extensively, we would certainly expect 2020 to see a decline in loss frequency, as well as potentially loss severity with fewer drivers on the road. There's going to be pressure to give some of that premium back to the consumer, but we feel that the reduction in loss frequency will offset that to a great degree, and we expect the motor carriers to perform remarkably well in this environment. If you talk about the balance sheets of insurance companies, the companies overall are quite well capitalized. Lessons have been learned from the 2008-2009 financial crisis, so we see very strong levels of risk-adjusted capitalization as well as good liquidity levels. So, on that front, the non-life sector is well positioned to withstand the financial market volatility that we've been seeing and that we expect to see, certainly in Q2 and probably beyond. If I were to boil it down, this event, COVID-19 for the insurance sector at this point is really an asset event. As I mentioned, certain asset classes such as equities, real estate, commercial loans, CLOs, those sorts of assets, private equity, hedge fund, the more volatile alternative asset classes, those are the areas where we're going to see some difficulty, some volatility, and we feel that will be where the challenge is for insurance companies. But as I said, they're quite well capitalized, so we do feel at AM Best that they're quite well positioned to handle the financial market volatility that we're going to see in 2020.